Hi, I'm Rob Buchanan, the Chief Executive of Channel Infrastructure. As you may know, Channel Infrastructure is a world-class operator of fuels infrastructure in New Zealand and Australia. The business today owns and operates New Zealand's largest fuels import terminal, and we store and distribute 40% of New Zealand's fuel, including 80% of New Zealand's jet fuel. We've got over 290 million litres of fuel storage on site and in service today, and an additional 350 million litres of available tanks, available for conversion to either petrol, diesel or jet refined product service. Of this, we're about to bring online about 120 million litres of diesel and jet storage to further boost New Zealand's fuel storage capacity, and we'll start earning revenue in respect of those contracts in the second half of this year. Our business model was very intentionally set up for stable cash flows. We have 3 customers in the import terminal: BP, Ampol and ExxonMobil. Our customer contracts are structured with index take-or-pay mechanism, and around 50% of our revenue is completely independent of fuel throughput volumes. This model makes our company relatively resilient to significant demand or supply side shocks. Our board is focused on stable and growing dividends, with a policy to pay out 70 to 90% of normalised free cash flow on average over time. We target credit metrics consistent with a shadow credit rating of BBB/BBB+. In February this year, we released our 2025 financial results. Our underlying revenue and earnings grew by 4%. Our free cash flow continued to be strong and increased by 5% over last year, and our free cash flow conversion ratio increased from 67% to 72%. With a total dividend of 13 cents per share for 2025, this represented an 18% increase on the prior year. Just to give you a bit of an update of how we're trading, in the first quarter of 2026, diesel, petrol and jet volumes were in line with or above our expectations. Whilst the conflict in the Middle East significantly impacted fuel prices in New Zealand and elsewhere in March, during the month, throughput overall remained quite strong. Looking ahead to the 2026 financial year, in February we guided to EBITDA of between 95 to 100 million. Since then, we signed a new contract with the New Zealand Government to deliver around 93 million litres of diesel storage, or about 9 days of New Zealand's diesel throughput, in an accelerated timeframe of 2 months. We also announced that the Z Energy jet storage project will be completed 6 months early, and the bitumen import terminal, on which we're also working on, had expanded in scope. Reflecting this additional revenue, balanced against an uncertain fuel demand outlook in the near term as a result of the current fuel crisis, the board increased Channel's EBITDA guidance range to between 97 and 105 million at our recent annual shareholders meeting. Since we converted to a dedicated fuels import terminal in April 2022, we have delivered a total shareholder return of around 250%. Since conversion, we have proven our ability to execute on large capital-intensive projects safely, on time and on budget. The $220 million import terminal conversion project, which is around a 6-year project, has been undertaken and is now nearing an end, with only bunding work remaining. That project is still scheduled to be completed on budget. We've also embarked on 4 new growth projects over the past 2 years, which will deliver approximately 180 million before PPI indexation and additional revenue over 15 years. In addition to this, I referred to the recently announced diesel storage contract for the New Zealand Government. It's been a fantastic project and is really a classic use case for our under-deployed assets, or the significant amount of empty storage tanks that we've got on our site. We created a very unique and expedient solution to provide a massive amount of diesel storage in a highly compressed timeframe, and we're on track for completion. Last year, we also completed our first acquisition in Australia acquiring a 25% interest in the Somerton jet fuel pipeline to Melbourne Airport. We think this is a fantastic asset. Melbourne Airport is forecast to grow strongly in the long term, with the third runway scheduled to be completed in 2031 and 2032, and a significant amount of terminal expansion. And we own now a 25% stake in the only jet fuel pipeline servicing Melbourne Airport. We continue to focus on disciplined growth. Our first growth priority is Marsden Point at home, which will be transformational if we can achieve all of the growth potential at that site. An example of an opportunity we're looking at the moment is the potential Marsden Point biorefinery project. This project is a proposed large-scale renewable fuels manufacturing facility using parts of the former oil refinery and infrastructure on our site. This very significant project is continuing to progress, and a final investment decision is expected later this year. In the context of the fuel crisis and a renewed focus on the supply chain, a project which delivers domestic manufacturing for domestic feedstock could be highly strategic for New Zealand. Our second growth priority is consolidation along Channel's current supply chain to Auckland Airport. We already own a premium suite of assets in the New Zealand fuel supply chain, and it makes sense to see where else along our own supply chain we can add value, particularly in aviation fuel, which is forecast to grow strongly in the long term. Our third growth priority is to look at potential acquisitions in New Zealand or Australia where there's an opportunity to add value through our proven world-class operational capability, supporting our customers and targeting growth markets. I've already mentioned the first example of this, which was the acquisition of the Melbourne jet pipeline earlier or later last year. So that's a little bit about what we're up to. If you want to hear more, I encourage you to visit our website or contact us directly on investorrelations@channelnz.com.